Hello and welcome to the Investing on the Go podcast, brought to you by FundCalibre. I'm Ryan Lightfoot-Brown, and today I'm joined by Peter Meany, the elite rated manager of the first Sentier global listed infrastructure fund. Peter, thank you very much for your time today.
Thanks, Ryan.
Now, it's been quite the year for infrastructure, quite the year for many things, but in infrastructure, it's usually one of the less volatile areas of the market. But there are some areas that have been particularly hard hit by the pandemic. Perhaps we could talk about some of the winners and the losers in a lockdown environment, maybe starting with sort of roads, rails and airports.
Yeah, it's certainly been a challenging year for infrastructure. As you say, traditionally a more defensive asset class, given the tangible sort of cash flow generating businesses that we invest in. But COVID has had an impact that's certainly been unprecedented. The lockdowns that followed COVID had very direct impacts on transport infrastructure, so I agree that's a good place to start. The biggest impact was really felt in the airport sector. We've seen travel around the world, cease. Intercontinental or international traffic, is down more than 90%, and until we get some success on vaccinations, it looks like that will continue to be down a lot. Domestic and sort of intra-EU travel has been a little bit better. We've seen when lockdowns have been eased, domestic travel sort of getting back to somewhere around 50% of where it was before. Some of the regional travel, back to sort of 30 or 40%. So there are signs that when lockdowns ease, things can recover quite quickly. The thing with airports is it's that international passenger that's really valuable. They tend to pay a lot more to land at an airport in terms of passenger charges. They spend a lot more at the airport, and that retail component, as you know, airports around the world now make a lot of money from retail spending. And so, that Chinese passenger, for example, is very valuable. So we really need them to return for airports really to recover their earnings in a significant way. So airports, I guess we're taking a bit more of a cautious approach. Where we have had investments, they've been really focused on lower leverage and more leisure travel. So Aena, the Spanish airports, Zurich airport, we think of are examples of better positioned companies. When it comes to other transport, railways, passenger rail has really struggled a bit like airports. Shinkansen bullet trains, for example, in Japan have been down a lot. Freight railroads have recovered better. So we have seen a lot of volumes being moved on freight despite the COVID crisis. The thing we're most excited about is the toll roads. We do think that roads will recover the most quickly. We think that people will prefer a private vehicle to public transport. They don't want to be on a subway or a bus. They want to be in a private vehicle and social distance. So that's where we have a most significant overweight position, and we do think that will come back in the next few quarters. So, well.
Thank you. Well, that actually leads me on to my next question. So what areas of infrastructure are set to benefit or have actually held up quite well? I know we've talked about toll roads, but are there any other areas of infrastructure?
Yeah, toll roads will bounce back. The other area that has done well over the last year has been anything in the communications space. So mobile towers, data centres have held up really well. And that's probably not a surprise given how well tech in general has done across the market. Towers, their contracted revenue streams, the acceleration of move to mobile data has come through during COVID. And obviously we've got 5G and that upgrade cycle. You need a lot more towers to provide that high frequency, intensity 5G network. And towers will clearly benefit from that. Data centers, clearly, as we move more into the cloud and that process is accelerated, both from corporations and retail demand on Amazon and so forth. Data center usage has gone up as well. So their growth has accelerated and they've been clear beneficiaries. I guess the other area that we might come to is the utilities. Utilities have held up quite well, although they held up when the market initially fell, and they've been, which is great, but then they've been left behind as the market has rallied back, a bit more boring and defensive. People have gravitated to cyclical growth and tech. So they've been left behind a little bit. The one bright spot has been renewables within the utility space, which has done well.
Yeah, I imagine it would really, because as we look forward, we're looking to, the theme we're using over here is the Building Back Stronger initiative, a lot of green infrastructure going on at the moment. Are the opportunities as big as people think they're going to be? What's your sort of outlook for the renewable sector?
Yeah, things are rarely as big as the headlines would suggest, whatever that might be. But certainly in the renewable space, there are a lot of exciting things going on. The Green New Deal in Europe, Biden and the Democrats' proposals, $1 trillion plus stimulus in the US. There's a lot of reasons to be positive on the renewable space. We're clearly seeing through COVID and out the other side, an acceleration of investment in wind farms, in solar panels, the transmission networks that need to tie all that together, will benefit. We're seeing an evolution in offshore wind that's quite well established in Europe, particularly Northern Europe. And as we move towards green hydrogen, that'll get another lift in supporting that industry. In the US, offshore wind is relatively new, and companies like Ørsted are taking that capability. SSE, we own in the portfolio, is clearly a beneficiary in the UK. But there are US companies that we own in the portfolio. Offshore wind, the likes of Dominion and Eversource will be beneficiaries in the Northeast and Virginia. And actually the world's largest renewable energy company, which is the largest stock in the portfolio, NextEra Energy, they're based in Florida. Their focus on onshore wind, solar, battery storage, and some early developments into hydrogen and what's exciting in the US, the electric vehicle rollout, where Biden is really supportive of that development. That will definitely lift their growth, and we do see growth lifting from 4 to 6 to even 8% for these utilities, which for boring regulated businesses is I think really interesting growth.
Yeah, I'm sure many of our listeners would jump at the chance of an 8% growth at the moment for some of their investments. And perhaps with those opportunities, there are other industries that are going to suffer, particularly oil and gas related services. What's going to happen to their pipelines, for example, if less oil is used? Is it a death knell for that industry?
Yeah, it's probably more a death by 1,000 cuts than something more dramatic. But there's no doubt as we move to net zero by 2050, which Europe is clearly aligned to, and I think under a Biden administration, the US will align to quite quickly as well. But under that scenario, and we've written a few papers on this, we clearly see a structural decline in oil demand. I think that's a natural outcome from the move to electric vehicles and ultimately to hydrogen as well. Some of the hard-to-abate sectors like steel, cement manufacturing, airline or aviation, that will take longer, but is certainly doable by 2050 with hydrogen. So we've been building into our forecasts that structural decline of oil. I would differentiate that, though, with gas and natural gas liquids or NGLs. gas will still be a very important transition fuel to support renewables that are intermittent by nature. We need some gas generation to support that, which is very flexible. Until renewables are fully developed, we probably need some gas to support hydrogen development as well. And NGLs are the input to plastics. And we've seen, the world still demands a lot of plastics. And we've seen all through COVID, actually plastic demand went up with, ordering online, Amazon deliveries and so forth. We still think there'll be very strong demand for NGLs, petrochemicals, and ultimately plastics that of course, also go into the cars like Teslas that, are still, have strong demand around the world.
And now, one of the big attractions of the asset class of the infrastructure space is the sort of contracted income streams that you get from there. How has the income of the fund held up, particularly in light of other equities having big cuts and a reduction in bond yields as well?
Yeah, look, this is really important to get a whole of portfolio perspective. I think, when people have looked at infrastructure, there's been a lot of focus on the airport space and some of the sectors that have really struggled. But actually at a portfolio level, when you take into account the utilities and the towers and, the toll roads that have bounced back quite well, what we've seen is income has continued to be produced from our companies. And actually, as we've gone through calendar 2020 and we push into 21, the actual impact on the entire portfolio has only been a decline in income of about 10%. You compare that with the broader UK equities market. I think I saw some stats saying, dividends were down about 44, 40, 50%.
Yeah, about that.
That's a real contrast. I look at the income being produced and what's been delivered, and then I look at the performance differential between the broader market and the infrastructure, and it doesn't make sense to me. I think infrastructure should have performed a lot better. I think the fundamentals support that view with the income being produced, and I guess therein lies the opportunity. If you've done really well in some other sectors like tech, and perhaps you're thinking a bit more defensively, look at something that's been left behind, then maybe infrastructure could fit that bill for you.
Well, that seems like a very good note to leave it on. Peter, it's been really interesting. Thank you very much for your time today.
Thanks, Ryan.
And if you'd like to know more about the elite-rated first Sentier global listed infrastructure funds, please visit our website, FundCalibre.com. And for more from our Investing on the Go podcast, please don't forget to subscribe via your normal channels.
Please remember, we've been discussing individual stocks to bring investing to life for you. It is not a recommendation to buy or sell. The fund may or may not be holding these stocks at time of your listening.